What's going on, guys? It's your favorite mortgage lender of Del Kawatmi, Got Mortgages. Happy Monday. I hope everybody had a blessed weekend. Weather was a little Just got back from a 3-day conference. That was pretty fun. We're going to dive right into it, diving in extensively in reference to the market. We're going to go over what is happening. I'm sure most of us have been seeing interest rates have been significantly dropping, which is awesome. We're going to go over what are some of the expectations that is causing the market to kind of react this way, what our expectations are heading into the next few weeks and months as we start seeing interest rates start to transition and take it from there. So the most important thing is education, right? So it's very important for us to truly just understand at this particular moment what is causing interest rates to start to trickle down, right? And we've talked about this multiple times, but I really want us to concentrate on these two main things. And we talk about the mortgage-backed securities and inflation. Mortgage-backed securities is essentially interest rates based off of the bond market, right? What are the cause of the bond market? And it's an inverse relationship. If mortgage bonds move up, interest rates go down. That means that investors are looking to simultaneously revert back to investing in long-term bonds, which make interest rates move down. Okay. Then we talk about inflation. We all know that inflation has been very, very sticky, and we can relate to it just from a personal perspective. When we went grocery shopping or we started buying certain things, we started to notice either packaging got smaller, but the same cost, or obviously things started to move up. Inflation at one point was almost at 9.1%, meaning if you literally bought something for $100, it was now $110, and so on and so forth, right? So that is some of the important things that we need to make sure we start monitoring. And the Fed has that dual mandate of both inflation and employment, of bringing down the cost in an effort to reduce consumer spending and have people start spending less money. So with that being said, we started looking at a lot of different changes that were starting to occur when we're looking at inflation. And the Fed did what? They hiked their interest rates to the highest it's ever been, anywhere from that 5.25 to 5.5% on that federal funds rate, really in an effort to slow down the spending and have people really start spending less money and kind of bring things back to life. Well, guess what? They did that for a little over 2 years. We know that interest rates on homes went from as low as 2.3 to as high as 7-8%. That's just from the real estate market. We know that the cost of things simultaneously also tended to also go up as well, which made a little bit of that slowdown, right? But again, interest rates are also based off of, like I had mentioned, unemployment filing, job reports, housing supply, affordability, and many other concerns. So when we talk about the employment rate, this is one of the main reasons why, aside from the Federal Reserve, which we're going to talk about right now. What's up, my man? We also started to look at a lot of the different unemployment changes. And the unemployment rate actually went from 4.1% to 4.3%. What is so important about this is because, remember, I had mentioned that the Fed has that dual mandate. The Fed wants to make sure that consumers not only are starting to spend less money, they also want to make sure that people obviously still have jobs. They want to ensure that consumers still are in a position to still comfortably either keep up with wage growth and allow the ability to qualify for stuff, but also really just have jobs. And we saw a job opening and labor turnovers last Tuesday came in significantly less. We also saw at the same time, the biggest shift was the BLS report, the Bureau of Labor Statistics, on Friday. Also simultaneously saw that downward trend. So we'll kind of go back and forth, but I want us to concentrate on right here on that BLS report. This is where we saw that fluctuation. So as we're seeing this trend, we're starting to see that the unemployment rate go up to 4.3%. Okay. With it jumping up to 4.3%, that is simultaneously showing, most importantly, that the people are having a hard time not only going out there and getting a job, because we're seeing continuing jobless claims close to almost 1.9 million. We're also seeing that continuing jobless claims continues to also rise. We also saw a decline on ADP. ADP measures private payroll, and that simultaneously also saw a reduction. So we're kind of seeing that common trend, right? Where February, March is a little tricky, right? We kind of saw a little bit of a shift, and I think a lot of it came from just consumer spending or a shift within the market. Usually happens after a quarter. And then we're seeing that big decline. And this made a huge difference, right? With only 122,000 jobs, I believe they were expecting roughly about 175,000. Not only were wage growth simultaneously start to moderate, but we saw it hit the lowest rate since January. Now, let's shift the stance a little bit in regards to the Fed and what's the reason behind this, right? So, the Fed has obviously that mandate of not just employment and inflation, but they also want to make sure, in regards to the market, that we try to really tiptoe around this expectations when we look at the recession, right? And if we take a look at where the recession have been, they really have been congruent and intermingled with other states. We know Japan came out the other day, kind of gave a little bit of their insight in regards to where things were headed from their standpoint, which also took a little bit of a shift on the market. But that's important, right? And what generally happens to the housing market during recessionary periods, right? The media might always, I can't tell you how many different questions I get from clients all the time. Well, we're holding off until the elections, or we're holding off until the recession. Many people don't know, if we take a look at this common trend, interest rates during recessionary periods have always diminished. They have always gone down. And that is truly because a lot of the declines in regards to really shows people that they have the ability to refinance. I can't even tell. I lost count as to the number of consumers who are reaching out, or colleagues who are recommending clients to reach out to refinance, and truly seeing that drop in that monthly payment that people have been really waiting for the last 2 years. The only time we saw a change was obviously in 2009, right? If we kind of see here, a very, very small, right here, I'm sorry, very, very small shift, very briefly, and then we saw a significant downward trend, and then once again, and we've really been kind of at that tiptoe right over here, staying stagnant as to that federal funds rate of just being over 5%. Now, again, the exception truly occurred, as I had mentioned, aside from the housing bubble, which is what we just looked at right now. Now, home prices, if we kind of consistently see, again, aside from 2008, home prices have always consistently gone up during recessionary periods, highlighting the start phases. And of course, we know where we have been on that positive transition of home appreciation since then, right? So, of course, the most important thing that we're going to start seeing now, a lot of different home buyers start to tap into the market, is truly just that expectation in regards to where rentals are shifting. But also, in addition, as rates continue to trickle down, we're now going to have added buyers start to enter the market. And this is where I think it's going to get a little tricky. Surely we'll start seeing some more supplies. Those consumers who have a 3 or 4% may be amenable to trading in a 3 or 4% rate with a 5% rate. So that is something that we know will simultaneously happen. But we're also going to start seeing a lot of significant above asking and really just hyper competing, kind of similar to what we saw during the COVID days. Okay. So that's a lot of the stuff. So again, these obstacles are going to truly come into place, but we want to make sure that we keep that focus in line, right? We know that the Fed came out and did indeed acknowledge that they were going to pause interest rates. We're likely going to see an interest rate cut heading into September. We know that that's been established. That's been something that was a consensus. Now, I believe, as I checked it today, there's about a 92% consensus that the Fed is going to be cutting interest rates come September. I firmly believe it. We're seeing inflation start to go down consistently with the CPI report, Consumer Price Index, the Producer Price Index with the PPI report, and then the Personal Consumption Expenditure report with PCE. All three have been consistently coming in alignment, showing declines in rates. We're also starting to see significant declines in regards to the employment job openings and an increase in the unemployment rate, which is starting to see that. But another thing I wanted to keep an eye on, again, 1.877 million people are continuing to apply. And just from that point with the JOLTS report showing that, again, the number of job openings have dropped. And it's dropped where, again, the hiring rate is at a 3.4%, the lowest it's been in 10 years, okay? And that quit rate remained at 2.1%, meaning truly people are afraid to quit their jobs because they just don't know if another job is going to be out there, okay? So, again, some of these things when we mention this, might seem detrimental, right, or scary, but we need these type of changes in regards to the market to truly start to show that impact in regards to employment. So, again, as unemployment rate goes up, which means that people are having a hard time finding their job, the Fed wants to keep that mandate as to, okay, well, we need to kind of pivot and make sure consumers still technically have that ability to qualify for a mortgage without us consistently hiking up the cost of rates, because that is going to come on edge with the standpoints that we have. And we just want to make sure that we're obviously staying with a comfortable GDP and a comfortable market. Okay. So that's pretty much it. I definitely appreciate you guys jumping on. I will be sharing this once again on our live channels later. So if you guys have any questions, please feel free to tune in on the following week. We will go over some of the changes, how interest rates are transitioning. But as we could see, really within the last year, we can kind of see we've been battling that focus. And then truly, I mean, the last just month, we've seen that consistent slow decline really bothering. We saw a sharp decline since Friday and really Thursday, Friday after the Fed spoke on Wednesday. So we're kind of seeing that decline took a little bit of a shift today. Mortgage bond market as of right now is reacting very favorably as well. We're starting to see again a little bit of a transition on that standpoint. So I'll keep you guys updated as always, and then hopefully we'll start seeing a little bit of changes when we talk about the changes with the mortgage-backed securities and the 10-year Treasury note. Right, it only shifted a 0.11%. Those are the items that we want to make sure we stay on top of, most importantly, in an effort to ensure that our clients have the ability to truly have the essence to whether it's to refinance or purchase and get that better interest rate that we so firmly want to make sure we accomplish. Okay, I appreciate you guys jumping on. As always, I will catch you guys soon. Talk to you guys later.